Hi, friends. Wish you all, along with your family, a very, very, very happy Holi. Friends, today we are going to discuss about the source of finance, particularly for a corporate entity. Friends, how a company or a corporate can raise funds to operate its business, whether for short term financing or for long term financing or a project financing. So, what are the key sources from where the company can source the funds? This is the topic for today's discussion. As we all know, the source of business finance includes internal funds. Internal fund stands for the funds which is generated through retained earning or owner's capital. And external funds can be raised through equity share funding, debt, bank financing, trade credit, and angel investors. These sources are used for long term capital investment as well as short term working capital, with choice depending upon the choice of either one should go for a short term financing or for a long term financing, depend upon there are certain covenants or conditions like cost condition, control condition, and repayment terms. So let us first discuss about internal source of funds, means funds generated within the corporate or company itself. First is retained earning. The first source of internal fundraising is retained earning. Means it means when reinvesting the accumulated profit of a company and invested in back in the business. So it is often called pluffing back of the profit. So this is popular source of internal financing. Second is owner's capital or equity. The personal savings or funds invested by the owners of a company is called equity financing. Then sale of assets. Selling obsolete assets, unused assets to raise immediate cash is also an internal source of finance. Now let us discuss about the external source of funds, means funds secured from the outside the entity. One is equity financing. Equity financing here means selling company shares to investors like angel investors, venture capitalists to exchange for the ownership of a company. Debt financing, borrowing money that must be repaid with the interest, such as bank loan, term loan, debenture, even compound financial instrument as well. Third source of external source of financing is trade credit. Suppliers allow businesses to buy goods now and pay later, that is short term. Invoice financing, it means borrowing against the money owed by the customer to improve the cash flow. Public deposits, unsecured loan accepted directly from the public. Government grants, subsidies, funds which is provided by the government bodies for specific projects, usually for startups, specific sectors like Startup India, Stand Up India. There are a lot of government programs which provide funding to raise the businesses, and for employment generation government basically provide these kind of subsidies to the entrepreneurs. So this is also an external source of finance. Now we can classify the source of finance as a short term finance, medium term finance, and long term finance. So short term finance means the finance which is less than a year, means the amount which we have taken for less than a year maturity is short term financing. For example, trade credit, bank overdraft, factoring, and invoice financing. Medium term financing means whose maturity is between 1 year to 5 year. Since 5 year is taken as a substantial period for classification of the financing, so it includes like bank loans, leasing arrangement, hire purchase arrangement, etc. Long term financing means the tenure is basically more than 5 years. It includes like equity shares, preference shares, debentures, bonds, term loan, and etc. So, friends, the external financing can be within the India and it can be outside India as well. That is called external commercial borrowing or loan from the overseas banks across the globe. So, this is all about a basics of source of finance which a company or a corporate can use for its funding or financing requirement and accordingly grow in its life cycle. So financing requirement for a company or a corporate is different in different life cycle of a company. For initial stage there could be a working capital requirement, maturity state there could be a medium term financing requirement, and in the long run for it require a basically long term financing. It depend upon the company performance, the industry in which the company relates to, the investor potential, management aggressiveness. So there are several factors which are basically used or taken into consideration to decide what kind of financing financial product is required for financing, and accordingly the tenure of the financing based on the financial product decided, financing tenure is decided, and obviously the mortgage requirement, the security, as well as the ROI and rate of interest, as well as RBI PLR also taken into consideration while taking any advance as a loan. So the most cheapest source of finance, if we think, would be equity, but it has its own merits and demerits. So this was all about, my dear friends, the source of finance which a corporate can use for its growth, for its development, and for its sustainability. So thank you very much, my dear friends. Again, I wish you all, along with your family, a very happy Holi. In my next video, we will discuss something about new more concept of finance, and will be able to enhance our knowledge in finance and accounting and taxation too. So with this, my dear friends, I stop this video. Also, I thanks for your support which you are giving me, the kind of love you are providing me, giving me. I request you to, if you like my videos and the content that I going to share with you, please share this with your known, your family, friends, or even in your professional group as well, so that I'll be get motivated to make more videos, good videos for you and your entire professional fraternity. So thank you very much once again. Happy Holi. Thank you very much. Dhanyawad.